What happened before credit scores existed? Imagine walking into a bank in the early 1900s and asking for a loan. There was no credit score, no digital record, no three-digit number deciding whether you were trustworthy. The banker did not check an online database or look at your financial history with a click. Instead, the decision often depended on something much older and more personal: your reputation, your relationships, and the word of people who knew you. Before credit scores existed, borrowing money was a completely different world. It was a world where trust was built face-to-face, where a handshake could sometimes be worth more than a document, and where your name in the community could determine your financial future. For millions of Americans, credit was not measured by algorithms. It was measured by character. In small towns across America during the late 19th and early 20th centuries, people usually borrowed money through personal connections. A farmer needing money for seeds, a shopkeeper wanting to expand a business, or a family trying to buy a home could not simply apply online or receive an instant approval. They had to sit across from a banker, a merchant, or a local lender and explain their situation. The lender wanted to know one important thing: could this person be trusted to pay back the money? The answer often came from community knowledge. Did the farmer work hard? Did the shop owner pay his bills on time? Was the family respected by their neighbors? These questions mattered more than any number on a computer screen. In rural America, local merchants played a major role in providing credit. Many farmers did not have enough cash to buy equipment, livestock, or supplies before harvest. Instead, they purchased goods on credit from local stores. The store owner kept handwritten records of every purchase. A farmer's payment history existed inside a notebook behind a counter, not inside a national database. If someone had a reputation for honesty and responsibility, they could continue receiving credit. But if someone failed to pay debts, that reputation could quickly disappear. Trust was powerful, but it was also fragile. During this era, banks also relied heavily on personal interviews and local relationships. A banker might know a customer's family for generations. They might know where someone worked, how much land they owned, and whether they had a history of keeping promises. Financial decisions were often influenced by conversations, personal opinions, and recommendations from respected members of the community. But as America changed, this system became more complicated. The country was growing rapidly. Cities expanded, factories multiplied, and millions of people moved away from their hometowns in search of new opportunities. Banks and businesses were dealing with customers they did not personally know. A banker in New York could not rely on personal relationships with every customer. A store owner could not simply ask neighbors about someone who had just moved into town. America needed a new way to measure financial trust. Before modern credit scores, businesses began creating systems to collect information about people's financial behavior. In the 1800s, some companies started creating credit reporting systems. These early reports collected information from merchants, lenders, and other businesses. Instead of a simple number, they contained written descriptions about a person's ability to repay debts. These reports were sometimes very detailed, including information about a person's occupation, reputation, and financial habits. However, these systems were far from perfect. Information was often incomplete, outdated, or based on personal opinions. Some reports could contain unfair judgments that followed people for years. There were no universal rules for how information was collected or evaluated. As America entered the 20th century, consumer borrowing increased dramatically. People wanted cars, appliances, homes, and other goods that they could pay for over time. Businesses needed faster ways to decide who could receive credit. The old system based only on personal relationships could not keep up with a modern economy. The financial world slowly began moving from personal trust toward organized data. The journey from handwritten notebooks and personal recommendations to modern credit scores was not immediate. It took decades of changes in banking, technology, and consumer finance. The simple question remained the same: who can be trusted to repay money? But the way America answered that question changed forever.